Afternoon. It's Saturday and 3 p.m. Just about time we want to talk about an important topic. I know this is the end of the year. A lot of times if you go to your tax people and they will probably tell you that, oh, why don't you buy 529 plan? So a lot of people knows about it, the buzzword of 529, right? You know, what is 529? Add up to 16, make no sense to you. And the 529 is a chapter of IRS tax code. It is what IRS put in place in 1996. So it is a way for parents or grandparents or somebody wanting to save tuitions for the kids against the inflation of tuition fees or also make tax savings. So let's talk about everything related to 529. That's what we're going to do this time. This webinar, it is going to serve as a Wikipedia for 529. So you listen to this webinar, you really should know everything basic for you about 529. Let's just get going. And you see our website, right? You see our website. This is where you can make appointment with me on this appointment button. If you come over here, and you will come up with all the partners in the firm, and you can decide on who you want to talk to based on their special areas that you see. After the webinar, we always put our webinar into this channel. This is YouTube channel. If you go onto YouTube, you type Community CPA, just like how it shows here, you'll find our circle logo on the channel. That is our channel. And you can actually look for right here, you can type in 529, then this video will pop up. And a lot of times, if the video gets a little more popular, it actually shows up on the home page anyway. So you will come here and find us. Now let's get going with what we want to do for today. So today's topic, it is 529 plan, all you need to know. And obviously, my name is Ying Sa. I am the managing partner of Community CPA. I am also a frequent speaker on YouTube channel, right? And I know I'm facing you, and when you talk to me right now, I couldn't hear, but you can put in your comments on anything you want to ask. This is about our firm, Community CPA. We are number people, just like we said. So we have all these numbers showing up here for you to signify things that's going on in our firm. So I want to mention to you that we have more than 12,000 clients, and we have 40 professionals, 27 years of public service. We speak 10 different languages collectively by our 40 people, and we have 6 partners in our firm, 5 different branches, and in 3 different states. And I myself served as in the committee, provide advices to IRS for 3 years, and we have 2 books on the internet, and it's a book I wrote, but it is really a story of our client and the Community CPA. So the 3rd book we have scheduled to show up, and which is to expand your business. We talk about how you start, how you grow as the 2nd book. The 1st book is the 2nd book. The 3rd book is expanding your business beyond yourself. Then, of course, the number 1, the smallest number, but it's the biggest number. It is our number 1 goals in our firm. It is our only goals in our firm is to have our firm be serving the small business in our community and with our heart and souls. I always say that because that's really what we're thriving to do and we aim to do. There's no other reasons. Community CPA is unlike your regular CPA firm. We didn't come out of anybody's business plan, and this is the firm that's driven by your needs. That's why we are here. These are the 2 books on Amazon you see is already there, and the 3rd one is coming up. And this webinar, whatever we are talking about, really measure that, right? Take it in with grain and salt, and don't just blindly quoting anybody in the webinar situation to make your action, because that is irresponsible of you you need to take responsibility for what you learn. And we don't have a service relationship just on the webinar. I speak, you hear, you listen. This is not a service agreement. So any content we have here, Community CPA is not liable. Just want to make that really clear. All right, history of 529. When we get into, you know how you find out that a lot of tax experts are actually older people. And I consider myself an older person. And, the reason is because the history comes in their back pocket. They got through the history. 1986. And 1986, I'm already in college. So it's really, those are the things you will hear. You will hear about people talking about, oh yeah, one of my classmates actually have 529 plan money. What is that? At that time, of course, I don't understand it, but I heard of the buzzword of 529. So because of the history, you hear that so long ago, so understanding of it is deeper. That's why every time I introduce something, I like to understand the history. If I myself did not experience, then I want to understand the history. So for young parents today, you are on my webinar. I know why you are here, because you want to understand it, but let me give you the history. This history, it is coming from 1986, got enhanced by IRS in 1996, 10 years later. So IRS introduced Section 529 into Internal Revenue Code to formalize this tool for college saving plan. So what the IRS did was to say that, okay, you put in $100 in 529 plan. If you make money in the plan, say you made $30,000, interest earning or capital gain, whatever that is, you made more money out of the 100. So what IRS code says, 529 code says that the earning of that $100 is not subject to taxes if you drew that out for qualified expenses. You see, I had a little couple of if, right? But these are the things you work around and you follow the rules, then you can make money in the plan, but you don't need to pay taxes. Both federal, state, you don't need to pay. But then, what about your 100? So the IRS did not say that, oh, the 100, you don't need to pay federal taxes. No, IRS 529 plan did not say that. But each state is doing that. So the state says that you don't have to pay state income tax. Maybe you are from Texas. You hear me talking, go, wow, we don't pay state taxes. Ying, what are you talking about? Those are different things that coming around with 529. Yes, in Texas, you put in the 529 plan and you don't pay state taxes already, so you don't get that deduction, right? But the earning in there, you take it out, you don't pay taxes on the interest income or on the capital gains. So you still benefit, but it's just not as big as someone from Iowa, someone from Minnesota, right? Someone from California. And the Texas folks, you just have to know that you don't get the state deduction because you don't pay income tax anyway, right? So the enhancement, the latest enhancement is on 2015. They further enhanced to include technology spending as a qualified 529 plan. So 529 plan to cover computer technology expenses. What does that mean? That means if you have a college kid with 529, when you buy computers for them, when you buy, programs and things like that for them, these are eligible costs. You can take money out of your plan without paying taxes. Now, there's two types of 529 plan, folks. Okay, so we introduced a little bit of the history. You know that it's not so old. I mean, really officialized that in 1996 is quite recent, right? And then you know that looking at this, now we say that there's two types. We want you to understand the two types because one is called 529 Education Savings Plan. And this funds can be invested in the mutual funds, other investment options, and the money inside is tax-free, right? Grow tax-free, and it can be used for qualified education expenses. So this is the normal 529 education saving plan. So if someone just talked to you 529 plan, they're probably referring to this one. This is 529 section, IRS section code for this type of plan. Basically, you put in and you still pay federal taxes when you put in, but you save the state taxes when you put in. But when you take it out with the qualified expenses, you don't pay taxes, both federal and the state. Make sense? So now let's look at, there is another one called 529 Prepaid Tuition Plan. Allow you to pre-purchase tuition at today's price for in-state public college and university. What is in-state public college and university? Like Florida State University or Iowa State University. So those are state-operated programs. And these plans protect against the tuition cost increasing, right? When kids end up, attending a out-of-state and a private school, and the state prepaid tuition plan can be transferred to the other state, okay? This is mainly with the state. So that's why the earning inside with no, the earning inside, you still don't pay taxes, both for the state and the federal, because it is still a 529, but it's a 529 prepaid tuition plan. You may say that, who do that? The state that doesn't have an income tax do a lot of that. For example, Florida Prepaid College Plan and the Michigan Education Trust. Michigan Education Trust is called MET, M-E-T. This is actually the oldest tuition saving plan. It started in '86. This is why this whole thing come about. Michigan has MET, and then find that to be really good. Then the whole country started this 529 plan. Michigan is an initiator. Mississippi Prepaid Affordable College Prepaid Tuition Plan, that is also another one. And then you have Nevada Prepaid Tuition Plan, and one in Texas as well. It's called Texas Tuition Promise Fund. That's what they call the plan. So those are the ones. I'm just giving you a couple examples so you understand. There's a 529 prepaid tuition plan. It's state-based in Texas, in Florida. But you don't worry, because as a parent, you may be working right now in Florida, so you bought into this prepaid tuition plan. But let's say you move to Iowa. Those prepaid tuition plan, because you are buying the in-state college, university, so you can transfer to another in-state college and university, to Nevada. And there's also a more universal ones under this prepaid tuition plan called the National Prepaid Tuition Plan. It's a private college 529, which means it covers about 300 private college. So if you're thinking of going to private school like Carnegie Mellon, and those are the national prepaid tuition plan that you can buy. So these are, just want you to have a big idea about what type of 529 plan you are looking at. You have these 529 plan, education saving plan, those are regular ones and doesn't really get identified into whatever state. But you also have 529, that prepaid tuition plan. It is more connected to the state. Makes sense, right? And now, who can buy those plans? Anyone, parent, relatives, friends, student themselves, right? It is, when you buy into 529 plan, just know that you are the owner. Let's say I'm a parent, I buy, in fact, I actually gone through 529 plan with all my 3 kids already. The last one graduated this December, so I no longer have any dollar in the 529 plan today because I used it, right? So I buy it for my 3 kids. So I bought for each one of them. But actually, my oldest didn't really use it because she didn't need it. So we actually moved the money to the second one, the third one. So 529 plan, you are the owner, you are controlling it. So you can decide to move them down the line if they don't use it. They got too much money for themselves, they don't need it, or they just don't go to college, right? So there's reasons why you don't use 529 plan. You don't lose it. You can give it to another person, to have another person be the beneficiary. 529 account belongs to you, belongs to the person who contributed to it, and you need to reflect that amount on your income tax return for that year. The owner maintains the control over the funds, right? So make sure that you know you are the one buying it for a beneficiary. That beneficiary can be your kids, can also be somebody else. And you just know that it's almost like a gift. You can obviously give gift to anybody, don't you? And you have this lifetime limit for the gift, but you can give gift to anybody. So how to open a 529 plan, you may ask. And very general, you can go to your financial planner, say, hey, I want to buy 529 education saving plan. But if you are going to buy those, the other plan, state specific, you want to contact the state office to find out who is the authorized agency to sell that to you. But normally on this first top one and 529 education saving plan, and you just go to a brokerage firm. You can go to Fidelity, and you can go to Ameritrade. You can go to U.S. Bank, Wells Fargo. Those, they sell that, all right? And so you can do, of course, some states, they also sell. They also have agency to handle 529 education saving plan. Once you bought it, and you want to notify your tax preparer, your tax person, so they can process your tax saving for you. All right. How to open the other one, I said, so you go to state-sponsored program, and if you do these 529 prepaid tuition plan, then just know that it's a state-specific, so you want to make sure you go to each state. So I made a list of those ones, right? All right, now you ask me, okay, so I know there's 2 plans, and I know which one I'm going to use because I live in Iowa. I'm just going to buy 529 education saving plan. And I know where to go now because I already have a financial planner, and I will just go to buy that. So, but how much can I buy it, right? A person can be a beneficiary of more than one 529 plan. So maybe, if this kid has mom bought it for him and the dad also bought it for him, so maybe grandparents also bought for him, but just making sure that this kid, you want to, the combined contribution from mom and dad or grandparents do not exceed the state contribution limit for the annual the limit, and also the annual gift tax exemption amount. So do you know what that amount in 2024? That is $18,000 from one person. Okay, so if it is 2, is $36,000, and so that's the annual limit. So you want to make sure that your beneficiary doesn't go over that amount, and then the person who can be the beneficiary can receive many contributions for the 529 education saving plan purposes. And the most plan has a total contribution limit ranging from $300K to $500K. So this is kind of controlled by the state. So for example, in 2024, Iowa 529 plan contribution tax deduction amount is $5,500, $11,000 for the couple. What does that mean? What I'm saying is that if you're residents of Iowa, you put money into your kids' 529 plan. Let's say mom put 5,500, dad put another 5,500, so the kid got 11K, right? So on the couple's tax return for the state, you would reduce your taxable income by 11,000, both of you, because it's 5,500 for each of you. So you pay less taxes on the 11,000. So let's say the state tax is 6%, then 11,000 reduction of your state taxes, you save 6% of the 11,000, right? So that would give you the tax saving you got right there. That is the contribution deduction we're talking about. And the due date to make those contribution is April 30th, 2025 for 2024. Okay? It is actually due on the tax due date. Not exactly tax due date. Tax due date is April 15, but you can put in before April 30th. So those details, you see why we say Iowa is because that's specific to Iowa. And for that education saving plan, the 5,500, that is the number that you across the country, like you do that 5,500. But how much to save you on the state depends on, number one, whether your state does income tax reduction or not. For example, if this couple is from Texas, then there's no state deduction because there's no state income tax, right? But you cannot put in more just because there is a contribution limit. Now, I will talk about a supercharging, super contribution later, but for right now, this is the limit for 2024. So what about the prepaid tuition plan? The prepaid tuition plan can be a you can also have, just like the other plan, you can also have multiple people giving to the same beneficiary. And then it is also the amount you can contribute depends on the current cost of tuition that in the state, right? And the total you can prepay is capped at the cost of 4 to 5 years of tuition at a in-state public college. So, so there is no number we are giving you because every plan is different. You want to make sure that the contribution is not going over your gift tax exemption amount. So we'll talk about that later. I will explain that to you. But most plan has a total contribution limit. Again, I'm giving you this number. You know that you can't put a lot of money in there, right? Because it is, generally speaking, there is a total limit how much you can put in. 529 contribution does not affect your gift tax. So let's just kind of take a step back because we keep on saying that, okay, don't go over gift limit. What does that mean? In 2024, you can contribute up to $18K to one or more 529 college saving plan without paying gift tax. When you give, let's say you give your kids more than $18,000. See, you're a mom and you want to give your kids more than $18,000 to this one kid. As a mom, you need to pay gift tax because there is a limitation, $18K per kid per person. So you want to remember that 18K is also not set in stone. Every year that number changes, and so many years ago was a lot less, right? So for a couple, it's 36. So one of your child can receive $36,000 from both of you in 2024 maximum. So you want to make sure that your 529 plan and it does not going over your limit. You can make a contribution. This paragraph, I want to read it out to you because this is important. Some people talk about super funding. This is, you can make a contribution of up to $90K for a couple is $180K in a single year, as long as you would not make any contribution during the 5-year period. It is called superfunding. This 5-year period can be the past 4 years plus current year. Let's say past 4 years you didn't make it, then the current year you didn't make it, so you make it a 5-year, you can do a 90K. The only thing to consider is the state contribution limit. You know, the state contribution has a limit, so you want to make sure this 90K did not add on top of what you already did and it's going over the limit. Superfunding can be done once without counting against your lifetime gift tax exemption, which means that you can do it once and you don't need to file gift tax return. Okay, so this is a super good benefit for someone, for some parents. You just got a lot of money in 1 year. You got a windfall, or your shares, your share vested with your good employer. You got just millions coming in 1 year. Then you have never put in anything for your kids. Then maybe this is the time to do a super contribution, super funding to catch up the last 4 years plus this year. So this is a contribution that would not affect your gift tax, and unlike what we are talking about, the 18K, right? But it has a condition. It has a condition that you can catch up, but for 5 years, you should not have done any 529 plan contribution. So qualified expenses, so far we've been talking about contribution, right? Contribution every year for 2024, $5,500, and for both couples is $11,000. You can do. I'm not talking about the tuition, prepaid tuition program. I'm talking about the education saving plan, right? Now you know. And then you have the super funding options that come to you right now. And in 2024, you can do that if you haven't really done 2023, 2022, and the 2021 contribution. Now, let's talk about once the money goes in, what become a qualified expense. 529 education plan, that's a tuition and the fees that your K-12, you can also use it, but limited to 10K per year, right? And the room and board. Obviously when you go to college, you have room and board, right? And the books, supplies, equipment, and computer required by the school, and the student loan repayment up to 10K lifetime per borrower. So your kid borrowed tuition loan can be, you can do 10K out of the 529 plan. Pretty reasonable, pretty flexible. Personally, I did not find difficult at all to pay for the kids' tuition out of 529 plan. And we actually do have 529 plan. One of my 529 plan was coming from the credit card expenses. So like one credit card, when you spend credit card, they give 2% of the credit card spending into the 529 plan. It takes a little bit of setup, but we literally had that for almost 20 years. So there's about like 38,000, 40,000 in the credit card. So that way it can be used for a qualified education plan. So it was, it take a little bit of setup, but I don't know whether there is still such a thing existed right now on the market. But I want to just make a point by saying that when you use it, it was not difficult to use at all. And I'm saying that from my own experience, so it's not something I'm imagining, right? So for the qualified expenses, for those prepaid tuition plan, which is really specifically to that plan, and you want to make sure that to look into it, normally it includes tuition and the mandatory fees for the public in-state college and universities. All right, let's kind of take a breather here. We talked about contribution, right? How that need to watch two things, gift tax limitation and also state limitation. Then when come to expenses, we listed a bunch of expenses. We're sitting here thinking that I don't know what expenses will not be covered by 529. They are covering everything, in my opinion, right? So now let's just summarize on that. So what is the income tax advantage? Contribution can lower state taxable income to reduce state tax. And each year, the plan has earnings. The earning grow inside of the plan is tax-free for both federal and the state. You don't get an interest statement to pay for taxes, no. It just grew silently in the plan. If you don't look at your statement, you will never see that on your tax return other than the year you made a contribution. Then qualified withdrawal is tax-free for both federal and the state as well, as long as you use it to pay for qualified expenses, right? They're just tax-free. Now, how does that lower state taxes? You know how some of those plan, you bought it in the state, you don't pay income tax, then of course that doesn't apply to you. But in Iowa, let's just take a look at this. 2023 Iowa contribution limitation is $3,785. But in 2024, it's $5,500. It's changed, right? So if a couple only contribute 529 plan for one beneficiary, they can save Iowa taxes by reducing Iowa taxable income of $7,570. So look at that. This is the Iowa form. So the couple's earning is $127,000. Now they reduce that. Now, they reduce it. So no, that's not a reduction tax for the prior year. So that $7,570. This is not the best section to look at the form, but you can take that $7,570 times the rate. So let's use 6%. So then that will be $480 saving on taxes, right? Because this is income reduction, reduce the state tax. When beneficiary doesn't use the fund. So what if you bought it for your son and your son didn't use it, but you have a younger daughter who might use it? You change the beneficiary. You save the funds for the future education. Withdraw the funds when you have qualified expenses. But if you draw, without qualified expenses, you just close the account because you got tired of it, then you pay penalty, okay? On the withdrawal, you know that if the withdrawal is on the qualified expenses, it is always tax-free. If the beneficiary receive a scholarship, okay, so they don't really, they receive scholarship, they don't really want to use the 529 plan anymore. You can move to another beneficiary, right? But if you want to draw, if the draw amount is more than the scholarship, then 10% penalty will apply. You can still draw it, but pay income tax on it if it is equal to the scholarship. Let's say you just have one kid, 529 in there, and you have 30,000, but your kid got 30,000 scholarship. You can draw 30,000, just pay income tax without penalty. But if you draw 35,000, the 5,000 will pay for 10% penalty. Does that make sense? So, but if you draw for qualified expenses, you don't even pay taxes. If the owner draw the money from a 529 account for any non-qualified purposes, the owner need to pay for 10% penalty and income tax. The owner, not your son. You, the parents. All right? So this is an example. Let's say they earning 1K in the qualified plan. So they drew 3,800. So the earning is 1,000. The basis is 2,800. The basis just means that is what you contributed to it, and then you are because you are drawing on non-qualified purposes. So your $2,800, those are the basis, and you paid federal taxes already. So that part is tax-free for federal, but for the state, you actually got a tax exemption. If you are in Iowa, for example, you would end up paying state taxes on that $2,800, but that earning, that $1,000 earning is taxable on both federal and the state. You know, you're drawing for non-qualified purposes. Then you also have a 10% penalty. So this is where the 10% penalty is on the earning. So you paid $100 penalty, and you pay income tax on the $1,000. The original contribution, the $2.8K, is state taxable income. It's sort of related to your origin, right? So if you contributed into the plan, the federal side, you didn't really get a deduction on income tax. So your contribution to the 529 plan, a little bit like your Roth IRA, right? So you qualified, so you did it. But it is really for non-qualified purposes withdrawal. You know that if you didn't pay income tax when you contribute, you're going to make up income tax. Then you're going to pay penalty on the earning. Now, can I self-direct my kids' 529 plan? I have that question all the time. The answer is no. You cannot really self-direct, but you sort of self-direct because whatever plan you join with the financial institution, they give you a roadmap. They give you choices, so you can choose on your own, okay? But you really cannot say, oh, I want to buy a house inside of my 529 plan, so, when I sell my house, the earning is free. No, it doesn't work that way. So you can sort of make decision on pre-selected options. Make sense? Right. There's another huge question we get all the time. And other than, can I self-directed my kids' 529 plan? The answer is no. And then, how long can I have 529 plan? This is a question we got all the time. Indefinite. You can fund the 529 plan, and you can keep it for as long as you want. And there's no expiration days, and as long as you use for education, and you can move beneficiaries around, transferability is there. If original beneficiary did not use the funds, you can change beneficiary to another qualified family member without penalty. And this feature allows to continue use of the funds even if initial beneficiary does not pursue higher education. Makes sense, right? One more thing I want to bring to you. What if you just run out of rope? You don't have more any beneficiaries, your beneficiary didn't go to school, and you just stuck with this 529 plan. If you take it out, you got tax, and it's just like no place to go. As of 2024, you can roll over your full 529 plan money into your beneficiary's Roth IRA. The account must have been open. Your 529 plan has to be more than 15 years old. You cannot be opening today, and transfer Roth IRA tomorrow. No. The plan has to be that old, and any amount you contributed within the last 5 years doesn't count. So anything you did 10 years ago, you can roll that over to your son's Roth IRA. Open Roth IRA account for beneficiary, that's what you need to do. Lifetime limitation is $35,000, so you cannot do more than that. Okay? The rollover amount must also adhere to the annual Roth IRA contribution limit, which are $7,000 for individual under age 50 in 2024. What does that say? That means that you can roll over, let's say your plan is 16 years old. You can roll over your first 2 years amount to your son's Roth IRA and for $7,000 in this year, right? So what it says that you cannot go over the $35,000, so you just roll over and start rolling over, and that is allowed. So this is something that new, so you haven't really heard a lot of people talking about it. But if you end up in that situation with no more beneficiary can go to, and then you just start rolling that to the kids' Roth IRA. So Roth IRA grow free inside for your kids as well. And of course, your kids cannot do another Roth IRA, right? We do have this $7,000 limit individual. And your kids also, subject to the AGI limitation, they cannot be making $1 million already, then your Roth IRA not qualified, right? So there's limitations related to that, but generally speaking, they should qualify. Now, I want to take a breather. This is kind of like everything about 529. And I want you to start understanding there's two types of 529. I want you to start to understand that it matters where you claim as your residence. Because as you being Iowa residents, as you being Texas residents, you may choose different 529 plan for your kids, right? And you also kind of understand that the contribution of 529 plan, it didn't really save taxes on your federal taxes. Only save taxes on the state if you are in the state that charges income tax. Then you also kind of know that there's a limitation of every year how much I put in. So you regret that you haven't really put in much at all. Then use the super funding option, right? Just get it in. Get it in once if you didn't contribute for 5 years, right? So that's kind of things how you know on the contribution side. But then you may say that what's the benefit on super funding? I don't get tax deduction. You got a state tax deduction. The earning inside of the plan is free, tax free. And then we talked about 529 expense side, qualified expenses. And my personal experience is pretty much cover everything. What else doesn't cover? I mean, room and board, if it is full-time, and tuition, computer, what else you kids would spend? You know, really, in that age, they're just college students. And remember, you can even pay K-12 and $10K a year out of that 529 plan. Why not? Start putting in that money even when they're little, even when they're just born. In fact, we have clients start 529 as soon as the baby is born. Smart. They maybe go to private school. You can use that, right? Then we talked about, expenses being that way, and then we kind of talked about the last two slides. We talked about what if, can I hold it all the time? Yes, no time limitation. And can I roll it over to my kids' Roth IRA? Yes, there is some conditions, but that can be done. So all of these is related to your 529. So now, where do you go to get the 529? And you can go to the banks, they all do, and you can go to your financial planner. And at a community CPA, we have wealth division, and we can also help you. But the idea is that you want to work with someone who has your 529 plan gonna exist when your kids go to college. And if it is one person thing, I don't know. I always say that when you work on long-term plan, you need to work with service provider that is long-term. And it is okay to work with your niece nephews who just started working in this business, but make sure your niece and nephews and the people you trust can last as long as your plan lasts. Otherwise, you are just going to be ending up in a place nobody really knows what's going on, and you have to spend your own time to dig out who is now managing your account, right? So make sure that when you make long-term plan, you affiliate yourself with a bigger service outlay, because it will exist. Community CPA will exist. So your wealth division will exist. And the other financial planner making sure they're on the market for years and years. And just don't go for new, because the new might be great, but it also could fold in a very short time, right? So it is a risk analysis, and I will leave that with you. But I always believe that when you work with anything that for you is a long-term, you want to make sure the service provider would be there long-term as well. All right, so just our partner list. I just showed you in the beginning of the webinar that you can book our time and talk to us. It is the tax planning season, so we're providing tax planning service. 529 plan is kind of a thing we think about that as well, and to make sure that if we see clients has this need for getting any financial product, and we will check with our client, making sure they go back to their financial planner to get that done. But if they just don't have anybody out there helping them, and this is where we will refer you to where we think is best fit for you. Okay, and with our website, and please subscribe to our YouTube channel, because that's how you know what we talk about next day. And we are on YouTube literally 4 times a week. So we do a Saturday long topic, Tuesday a short topic, and then we repeat our Saturday, Tuesday topic in Spanish, and another one in Chinese. So that is how we keep our clients comfortable. So if you want to hear in English, you have me. And my English is truly English, is Yinglish, because I'm not native speaker, so my English has shortcomings. But because of that, I speak a language that is easy to understand. I explain things so comfortable to people. They find my webinar doesn't run around, and my webinar speak what you need to understand. So that's our character. That's our way of teaching. So we hope that you really enjoy it. Catherine@communitycpa.com. That is Catherine's email. She is our marketing manager, and you want to email her if you have a specific topic you want us to talk about, and go to her. And you can also call us. We open 6 days a week. Like right now, our office is open. If you call our office, and we would have a real person picking up your call and direct you to the right place. So I hope to see you again on Tuesday. I haven't really decided my Tuesday topic yet at this time, but I will see you on Tuesday. It will for sure be a good topic. If you subscribe, you'll know it ahead of time. I'll talk to you. Bye-bye.